All right, here's the deal. Most people think mortgages are about rates. They're not. Rates are the output. Structure, timing, and behavior are the inputs. And if you don't understand that, you're guessing with the largest financial decision of your life. The mortgage industry has trained people to obsess over one number, the rate. But focusing on the rate alone is like judging a business only by revenue and ignoring everything else, ignoring expenses, risk, cash flow. It's incomplete data. And incomplete understanding leads to bad decisions. Most borrowers walk into the process believing three things. First, the lowest rate is always the best deal. Second, that all lenders are basically the same. And third, that waiting is safer than acting. Those beliefs feel logical. They feel responsible. They're also wrong. Not because people are unintelligent, but because no one ever slows down and explains how the system actually works. A mortgage is not a product you buy off the shelf. It's a risk contract. You're not getting a loan. You're entering into a long-term agreement, typically a bank, where someone is betting on your ability to perform over time. Lenders don't price loans based on vibes or fairness. They price risk. They look at how you use credit, not just your score. They look at income stability, not just income size. They look at liquidity, not just down payment. They look at the broader market environment at the exact moment you lock. Think about buying a stock. That's why two borrowers can apply on the same day, buy the same house, and walk away with completely different outcomes. Same purchase price, same loan amount, different rate, different fees, different structure, and different approval strength. And people look at that at the end and say, hey, that's unfair. Well, it's not unfair, it's just math. It's complicated math, but it's just math. The system isn't designed to make everyone equal. It's designed to price probability. Right now, a lot of confusion comes from one thing, anchoring. People are anchored to 2020 and 2021. Those post-COVID rates were so low. Those years rewired expectations. Ultra-low rates became the baseline in people's minds. But those were not normal. Those were emergency conditions. Those were the financial equivalent of a defibrillator. And guess what? We're paying the price now. Historically speaking, 6 to 7% mortgage rates are normal. They're boring. They're stable. What actually drives housing affordability over time isn't the rate alone. It's income growth. It's housing supply. It's payment strategy. When people say, I'm waiting for rates to come down, what they're really saying is, I want certainty. And certainty feels safe. But in housing, waiting often has a hidden cost. While you wait, prices can rise. Competition can increase. Terms can tighten. Rent keeps going up, which erodes your purchasing power. Waiting feels conservative, but it's not neutral. It's a decision with consequences. Here's something most people don't think about. You don't marry the rate. I know, cliche. You don't marry the rate. You marry the house. The rate is temporary. The property is not. Rates change. Refinance opportunities appear. Loan structures can be adjusted. But the purchase price you lock in, that's permanent. Smart borrowers understand this distinction. They don't ask, is this the lowest rate I can possibly get? They ask, is this a payment I can comfortably control, and does the loan give me enough flexibility to make a change as I need to? Payment control matters more than rate obsession. Let me repeat that. Payment control matters more than rate obsession. Structure matters more than surface level savings. A slightly higher rate with better flexibility, lower risk, and a clear refinance plan often beats the lowest rate that traps someone financially. Another misunderstanding is that all lenders are the same. They're not. Oh my God. Some lenders are rate quoters. Some are transaction processors. Some are true advisors. A rate quoter's job is to give you the number. An advisor's job is to help you understand the trade-offs. The trade-offs could be fixed versus adjustable rate, a fixed mortgage versus an adjustable rate mortgage, your cash to close and your long-term payment, certainty today, flexibility tomorrow. Those trade-offs don't show up on a rate sheet. They show up over time. And right now, markets are so volatile. Volatility scares people, but volatility also creates opportunity. Prepared borrowers, they benefit from volatility. Unprepared borrowers, they tend to get crushed by it. This is why timing the market is overrated. You can't predict rates with precision. You can't predict policy. You can't predict headlines, but you can control preparation. You can control your credit behavior. You can control your documentation. You can control your liquidity. And you can control how well structured your loan is. People who wait for perfect conditions usually miss good ones. People who understand the math move when the numbers work. Another mistake people make is treating the mortgage like a trophy. They want the lowest rate, the biggest approval. They want the cleanest bragging rights. But guess what? Mortgages aren't trophies. They're tools. A hammer isn't impressive. It's useful. The right mortgage helps you sleep at night, control cash flow, and adapt when life changes. And then you can pivot when the opportunity shows up. The wrong mortgage can lock you into rigidity. And rigidity breaks people when circumstances change. Job changes, family changes, market changes. Flexible borrowers can survive those moments. Rigid borrowers struggle. And this is why smart borrowers think in scenarios, not snapshots. They ask questions like, well, what happens if my income changes? What happens if the mortgage rates drop? What happens if I want to move in 3 to 5 years? What happens if I want to invest more money later into the market or into an investment property? Those questions matter more than today's rate. Most people never ask. They just rush to close. They chase certainty. They trust headlines. And then they're surprised when things don't work out. It's just absurd sometimes. This is where advice matters. Not sales, not pressure, advice. The borrower who wins long-term aren't more aggressive. They're not luckier. They're just calmer. They just understand that housing is a long game. They know that no loan is permanent, no rate is forever, and no market stays frozen. They typically just focus on the fundamentals. They work with people who explain instead of sell, who slow things down instead of rushing decisions, who can talk about risk as clearly as reward. That's the difference. That's how you stop guessing. That's how you make mortgage decisions that actually serve your life, not just today, but years from now.